Hey guys, RC Peck here with Fearless Wealth, and I have three things that I'm going to cover in this video. The first is I'm going to talk about gold, and I'm going to show gold in a way that either I haven't shown it before or I haven't shown it in a long time. And whether you own gold or not, you're going to get something out of it, because a lot of what I talk about, actually most of what I talk about, is about psychology and how the way you think actually impacts how your money grows more than anything else. So that's the first thing. The second thing I'm going to cover is I'm going to talk about the places of the stock market where you've been taught that you are being protected from the downside. So I'm going to show three specific areas of the stock market where you've been sold the idea, you've been told the idea that if you own this part of the stock market, it's going to protect your downside. And the reason why this matters to you is if you own these parts of the stock market, you can understand a little bit more about why that relationship with your big box advisor, or even that relationship with yourself, can be so expensive. And the third thing I'm going to talk about is why, is comparing now, this is the end of 2020, with the end of 1999. And the reason this matters is because if you've been getting sold this idea that this is 1999, let's just go back and look at 1999. So again, whether you're in those things specifically, you're going to learn a lot from this video, because it's going to teach you and show you how maybe you're starting to, or how you've been hurting yourself based on kind of a filter that allows in trauma and drama and anxiety and stress. And it's that filter that actually needs to get changed. So let's jump over to the price charts and let's start with gold. Okay, let me get the screenshot here. So this is actually GDXJ. This is small cap precious metal mining shares being priced in S&P 500 units. So look, it bottomed here in September of 18 and is in this uptrend. The thing I want to show is when it breaks below this when it breaks below this trend line down here, this uptrending trend line, when it breaks below this, it got below it before and broke above. It got below it before and broke above. And now it's below it again. So I often talk about with my training clients, you want to know when to step. Like step in, step out, average in, average out. And if GDXJ cannot strengthen against SPY, it's going to be yet another nail in the coffin of precious metals right now. Maybe not forever. Of course not forever. There are very few absolutes in life. And I actually discount this big, huge drop here because that was the COVID crash and just crazy insanity things were happening. But so GDXJ divided by SPY, that's a relative price share. If the black line is going higher, small cap precious metal mining shares are outperforming. So we're going to see here if GDXJ can recover relative to the S&P 500. Why the S&P 500? It's your free stock market rate of return. It's free to own, it's free to buy. If what you own cannot beat the free stock market rate of return, then what are you doing? Why are you in that? So that's the first thing I want to talk about with gold. The second thing is I just wanted to show you gold priced in Swiss francs. So the reason why this pricing of gold matters is the Swiss franc is often considered a safe haven, a place to put money when the world is crazy. It's kind of the fiat currency of gold, right? It's the gold-like fiat currency, or it's the Bitcoin-like fiat currency, if I can say that. And as you can see, this is its old highs over here, where this is gold priced in Swiss francs. Could not break above basically this 1625 range. 1, 2, 3, 4, 5, 6 attempts. You might either call that 6 or 4, but attempted to break above, couldn't. Finally broke above it, stayed above it, took off, and is back down in that range. So it'll be interesting to see if buyers will come in, and definitely if gold breaks down in Swiss francs and dollars, that's going to pretty much end the bullish case over the short run for gold. The other thing I want to show you too with gold is this is gold priced in US dollars, and the big price we wanted gold to stay above was its lifetime high of $1,900, which is the top blue line, but I'm giving you a little bit of a range. The second number, if it broke below that lifetime high there, which it has not done in Swiss francs, is this $1,800, right? This is a big, and look, most of gold traded around the world is in US dollars. So when gold came down to that 1,800, call it Monday-ish this week, buyers came in. So that was a bullish sign that all is not lost. But again, our job is to practice detachment, and it has to be more than a saying. There's actually a process you go through that's very quick and very streamlined that I train people to do so they can stay dispassionate about what they own, and they can stay very passionate about how their portfolio is growing. So that's the first thing I wanted to cover was gold. The price chart I hadn't shown before was gold priced in Swiss francs, and how Swiss francs is often considered kind of the safe fiat currency. The other thing I want to quickly show, and do I have it here? I don't have it here. Okay. The other thing I want to show too is GLD came out in 2005, and I think that helped gold go higher. GBTC is the GLD of Bitcoin, and Bitcoin is testing up against new lifetime highs, BTC. So for me, another thing that's interesting is Bitcoin is getting turned back at its 2017 lifetime highs. And if that turn back gets confirmed, the place it's likely to go is right down to kind of this $13,000 support to come back there to find more buyers. But right now, and I can zoom in, I'll zoom in here. There's its old lifetime high, the horizontal gray line, and you can see right now, not in a crazy way, but sellers are coming in, and Bitcoin is having a very hard time with attacking its new lifetime highs again. Again, most likely if it can't stay above, and the big thing is if it breaks below 17,000. So that's really the major, if Bitcoin drops below 17,000, the next place it's going to want to go is right down here to about the 13,000, 12,500 number to see if more buyers will come in. Now, you don't need to own Bitcoin. I run these videos so you can start to hear and see how to look what price is doing and less what the news is doing. And for you to look more and more at the sources in your life that are scaring you. If a price chart scares you for the correct reasons, then you probably should be scared. Owning something that is going up and to the right is not a reason why you should be scared. Okay, so that was a little bonus with Bitcoin. I didn't mention that at the beginning of the video. I'm going to go a little bit out of order here. So I want to talk about, is this 1999? So here's a price chart of the S&P 500 dividends reinvested over the last 5 years. So this is 5 years. Now from the very bottom, lower left, right down here, if that's in fact, I'm doing it, up to there, let's call that 100% gain. Dividends reinvested. So 100% gain over 5 years, pretty darn good. That's a good return. Okay, here's 1999. So here's a price chart of the 5 years leading into December, where we are today, 1999. Now this price chart, remember, going into where we are today for 2000, the S&P was up about 97%. This is up 246%. 246%. And where we are today is up about 97%. So it's really hard to compare December 99 with December 2020. Absolutely. The problem is people have never been trained to filter out all of the crap, all of the BS, all of the fear mongering. And so what happens is their filter allows in that anxiety and that stress and starts sitting in their body and literally hurting their health. But it doesn't have to be that way. Okay, and lastly, Let's actually, what am I doing here? Let's pull up, get out of this price chart. The last thing I want to talk to you about is the parts of the market that you were told would protect your downside. And your big box advisor either explicitly said, well, he or she wouldn't say this because they probably can't, but they would say things like, I'm going to put you in something that's low volatile, or I'm going to put you in stocks that have been raising their dividends for 25 to 50 years, because those are the stable parts of the market. Or I'm going to put you in the part of the market that has the least volatility, right? And so when you hear those words, least volatility, low volatility, value, deep value, dividends getting increased over a quarter of a century to half a millennium, half a century, not half a millennium, 25 to 50 years, what happens is your brain goes, I will be protected. I will be protected. The problem is when you're then not protected, you literally don't understand what's going on. And this is why so many people want to replace their advisor. Okay, so the first one is I just want to look at, this is an ETF called S&P. Just listen to the name of this. The Invesco S&P 500 Low Volatility ETF. So when people hear that, they think, I will be protected on the downside. When their advisor says, hey, I'm going to get you some S&P 500 low volatility shares, your brain goes, we need to protect myself because I'm at 50 or I'm 60. Look at this though. So SPLV, which is S&P 500 low volatility, let's just get that right there, fell 36% this year. 36. Now the S&P fell 34. So this had more volatility than the S&P. Now, when things rebounded, this low volatility thing went up 42%. So it was higher volatility on the downside. Okay. And unfortunately, it was lower volatility on the upside. For reference, just SPY, the upside rebound was, I already told you S&P fell 34%, not 36. S&P's up 65%, where SPLV was up, 43%? So, yeah, 42%. So you're missing a huge chunk of money because people are not taught, it has to be trained how not to be hijacked. Okay, but we're not done with this. Noble is an ETF. This is the ProShares S&P 500 Dividend Aristocrats ETF. So this is an ETF that owns stocks that have been raising their dividends for over a quarter of a century. And some of them on this list have been raising their dividends for over 50 years, half a century. So one would think, you hear that and go, that's going to protect my downside. Well, this year, that thing fell 35.4%. It fell more than the S&P 500. It fell more than not less. And then on the upside, the S&P is up about 65%. This is up 65%. So this fell more, but is only up as much. It doesn't make sense. And the reason is because we've been taught to use shortcuts like, what's the word? I invest with words. I invest for words. I invest for the word dividend or income or aristocrat, right? Or increased dividend over 25 years. And then lastly, a lot of people are in, I would say a lot of people over the age of 60 are in value stocks. Because again, they've been taught that a value stock is safer. And here a value stock, this SPY V is down 37% during the COVID crash. And then on the move up, the S&P was up 65%. This is up 56%. So it's very similar. The corners of the market that people have been told that are going to protect their downside are not protecting their downside. And it's because everything has changed. When we use words as our filters, we can get in trouble. We own value stocks or low volatility stocks or aristocrats. We own things that actually cannot protect our downside. So a couple takeaways here. It's not 1999. It's 2000. There's very few similarities to 2000. I do not believe there was trillions of dollars of balance sheet expansion. And really, it's tens of trillions of dollars of balance sheet, central bank balance sheet expansions because of all the central banks around the world. It's tens of trillions of dollars. So things have shifted. Governments are acting differently. Central banks are acting differently. Back in 99, let's just quickly do this. So let's do this right now. Right now it is, on this price chart I'm looking at, this is today, December 11th, and today the yield on a 10-year US Treasury is 0.93. So you give the US government $1 million. They will hold it for 10 years. You'll get your $1 million back, and every year they're going to send you $9,300. Let's compare that to 1999. So in 1999, let's make sure we have the dates right, you gave the government $1 million. You gave the US government $1 million to borrow. Okay, you get your $1 million back at the end of 10 years. And every year for 10 years, they're going to send you $63,760. There was a lot of competition to the stock market. You could let the US government borrow your money for 10 years and they'd say, you know what, we'll give you $63,000. Let's just round it because it's $63,700. We're going to give you, I'm rounding, $64,000 a year for 10 years. For 10 years. For 10 years. So that's about $5,100 a month, something like that, okay? Today, they're not doing that. So the competition has gone away. The bond market's the biggest competition to the equity market. That's not there right now. So when someone says it's 99, look and see like, oh, it's MSNBC, CNBC, it's some crap newsletter. It's someone who's wanting to scare you or doesn't know much about investing. And what I mean by that is the world is interconnected, right? The stock market knows what the bond market is doing and vice versa and all those other things. This stuff makes a difference. The problem is none of this is trained into people. What's trained into people is to be over diversified. Thank you guys so much for being in my world. Please hit the like button if you like this video because it makes a difference. Thanks so much, and I will see you on the next video. Okay, bye. Hey guys, if you liked this video, you're absolutely gonna love our trading service. And if you've tried trading before and it hasn't worked or you've struggled, it's because you're making one of 7 mistakes, I guarantee it. And after the click, I'm gonna show you exactly what those 7 mistakes are. All right, I'll see you there.